How's it going today? This is Ryan from Ride Down Asset Management. Today I wanted to talk about syndications and other types of groups that you can pool your money together in order to invest in real estate. So what is a syndication? A syndication is when a group of people pool their money together in order to buy an asset that they wouldn't normally be able to buy. And that could be because of the amount of money needed to invest in it, or possibly the amount of experience needed to invest in it. But there are other options besides a syndication. One of these options would be a joint venture, where once again, a group of people, two or more, pool their money together in order to buy an asset. But there are a couple nuances with this, as well as a tenants in common, which is also referred to as a TIC. So there's three general ways that people would want to pool their money together in order to buy real estate. Let's write those down. So there's a JV, syndication, and there's a TIC, tenants in common. So each of these is generally for that goal, buying something that you wouldn't normally be able to purchase. But with everything, there's pros and cons. So let's go through and try to figure out what those pros and cons are and how one of these might work best for you. So let's start with a syndication, because it's a pretty big buzzword these days in real estate. It's also one of the more complicated ways of doing things. So a syndication, there are two groups of people, the GPs and the LPs. So the GPs, or general partners or sponsors, manage the deal. The LPs, or limited partners, are limited in what they do in the deal. Generally, the limited partners are they're investing money in the deal. Whereas the general partners do all of the work. They are the active side. So depending on what you're looking for, that could be a pro or it could be a con. So GPs are active and LPs are passive. Okay? So pro or con, depending on how you're looking at it. In order to complete a syndication as a general partner, you would have to have, you basically have to go through all of the steps. You have to find the deal. That means you have to generally work with a broker, or maybe you find an off-market listing. So you're networking, you're trying to find sellers, do that sort of thing in order to find a deal. So it takes a lot of upfront work. Once you find that deal, you're going to underwrite it. You're going to see if the numbers work for you. You're going to see if it works for a syndication model versus another model. And there's really a lot that goes into it. Once you get to that point, you say the deal works, you move on, you get it under contract, then you'd have to start raising money for it, raising capital, which you'd have to go into your network of people that you've been marketing to, friends and family, co-workers perhaps, other people that may be interested in real estate. So there's a lot going into the GP side. There are a lot of different roles, and typically it's split, although it doesn't have to be. There is asset management, acquisition. So acquisition is, finding the deal, underwriting the deal, all of that. There is risk capital. So risk capital is the person that's putting up, or a group of people that's putting up the money initially. That could be for third-party reporting, your earnest money, etc. There's also capital raising. So capital raising and investor relations. Finally, there's generally a sponsor or balance sheet guarantor. Depending on the people on your team, this could each be a separate person, separate group of people, or one person could do multiple things. It really just depends on the experience of the people on your GP team. Now, each of these people is also compensated differently. So generally, there's some sort of a split between the GPs and the LPs. And this can get very complicated. There can be hurdles, there can be waterfalls, and all sorts of different things that split up money differently. most times nowadays, you'll see somewhere between an 80-20 split and a 70-30 split. And that's going to be, let's say, 20% on the GP side and 80% on the LP side, or 70% and 30%, or something in the middle. It can be more or less. It could tip either way on the scale, depends on the deal. So after that point, each of these people are going to be compensated within that percentage. And that's how they, make money on the deal. Now, if you're on the LP side of things, there's quite a few pros. One, as I mentioned, is it's passive. Very good thing, because time equals money, and time is the most important resource in the world, and it's non-renewable. So having passive income is extremely important. Another pro is that you don't have any say. There's no voting rights, no voting. So you might think that sounds weird, but it's actually a good thing, because once again, it frees you from responsibility. In this way, it's very similar to a stock, in that you're putting in a sum of money, and you don't have any say in that stock. It's either going to go up or down. But we hope, real estate it's very risk adverse. So it's generally much more safe than a stock. It's generally going to stagnate or go up in terms of markets. But there's a lot of good things about this versus a stock. But let's not get into that right now any more than I just did. Another thing that's a pro of being an LP on a deal is that there's a maximum amount of money that you can lose. So generally, a syndication is going to be a non-recourse note. And that means that, you put in, let's say it's $1 million deal. There's, that might be a little small for a syndication, but for ease of numbers and math right now, $1 million deal. So we're gonna have $200,000 to $250,000 down. We're gonna have in addition to that, we're going to have closing costs, and we're going to have our reserves. But let's say that on this deal, an LP is going to put in $25,000. That means that they, even if this deal goes south, the most that they can lose is $25,000. They're not putting up their balance sheet. There's no opportunity for them to lose any more capital than that. They can't lose their primary residence. They can't lose a car, a boat, whatever else. So that's a huge thing, especially if your risk tolerance is low. It's another huge positive thing about syndications. Another pro is generally, I say generally a lot, because everything varies in this business. So, this is all kind of rules of thumb. It can change from deal to deal. But normally, you're going to get paid on a quarterly basis. We're going to make distributions quarterly. Sometimes it could be monthly, and on a rare occasion monthly. Other times it could be bi-yearly or yearly. And there are also different ways that this is set up in the PPM, Private Placement Memorandum. Whereas depending on the deal, you might not get paid out for the first year or the first couple quarters. If it's a higher value add deal, higher risk in the beginning, maybe there's an extremely low occupancy rate and you have to get that leveled up. You have to start collecting more rents, things like that. So that could change. But having that distribution, having that cash flow, that passive income that you can count on makes this a very nice, type of asset to invest in. Another thing is appreciation of the property. So there's forced appreciation, meaning we are increasing rents, we are stabilizing expenses, or possibly even decreasing expenses, and we are increasing our NOI in general. In commercial properties, an increase in NOI means an increase in value. So you're forcing that value up, gaining you and your investors appreciation. That's on the GP and the LP side. Another positive is tax depreciation. You're lowering your taxable balance through investing in real estate. And, as I kind of alluded to already, It's great returns with a low risk. Non-recourse, low interest rates, low break-even occupancy. All great things about this. Cons to it, I ran out of space on this. Cons is it is expensive to set up. So if you're doing a smaller deal, it may not make sense to go into a syndication. Generally, it's going to cost at least $10,000, probably closer to 15, and beyond that, depending on how many investors you have, how many states they're investing from, because you actually have to pay each state that you have an investor in to set up. You have to have your SEC attorney. So that goes into the complexity of it. Because it's a security, you have to work with the SEC, and that's why you have your SEC attorney. Don't do any of that stuff on your own. Hire the right people. As you work with them, there is a lot of paperwork. So that's, of course, a downside, but you can get through it, especially with their help. Couple other cons is if you're an LP that wants to be active, then a syndication isn't for you, because honestly, you cannot be active by law. That's what a syndication is. You have your active side and you have your passive side. Lastly, I would like to point out that as an LP, you are relying on the GPs. You're relying on their knowledge and their skill and their knowledge of real estate, the actual asset that they had chosen, and you had to do your due diligence on that team as well as the asset itself, the city, everything like that. You want to totally trust that team because you're hands off. It's the same as if you were to buy Apple stock. Do you believe in Apple? Do you believe that Apple's going to go up or stay the same, or you're not going to lose money on it? You just need to know that up front. Okay, so now that we went through kind of the overarching what is a syndication, I'd like to talk quickly about joint ventures or JVs. Just like a syndication, a joint venture is when a bunch of people group together in order to buy an asset. The difference here is that we don't have these two teams like that. In a JV, you have a bunch of different people, two or more, combining to buy an asset, but they actually maintain their own entity. So although they have a common goal, a common asset, they have their own entity, let's say an LLC in this case. One thing about JVs versus syndications is everybody can make decisions. So if you're involved in this, you are making decisions. So you do have voting rights. Now, this voting right is directly related to your percentage in the deal. And your percentage in the deal is your percentage in the deal, as well as your responsibilities, are all mapped out prior to doing this. That's something you need in writing before you do this, before any of these things. You never want to just have like a napkin agreement, a handshake. That doesn't work in these situations. There's large sums of money at stake, and you need to make sure that everybody on your team is in it and in it for the entire process. So you need to work with the proper people to write up the contracts and agreements for these things. Another pro or con, depending on how you're looking at it with this, is everybody is going to sign on the note. So everyone guarantees it. Now, that's going to happen nearly 100% of the time, versus over here where only the GPs are signing on the note, not the LPs. With the JV as well, you can go the recourse or the non-recourse route. So if you're going the recourse route, you have all that extra stuff at stake. You have to show the lender, maybe a community bank, maybe somebody else. You have to show them your balance sheet. You have to put that on the line, which, not everybody wants to do that. Not everybody wants to risk everything. Even if you think you have a great deal that you're going into, there's always a possibility that something would happen. Finally, I'd like to talk about tenants in common, or the TIC, real quickly. Very similar to a joint venture. One of the pros about doing this, and why I'm actually in one now, is you're able to combine 1031 money with cash. So if let's say you're getting into a deal, you have a total of 3 people, maybe 1 or 2 of those people have money from a prior deal, and they are doing a 1031 exchange to get into this deal, that would allow you to combine those two sources of money and get this deal completed. Again, it's a group of people forming together, pooling money in order to buy a certain asset. With the tenants in common though, one of the things is each investor is called a tenant here. If one of the tenants dies, then their share is then passed on to either their estate or whoever they listed in the contract originally. So that's one of the major things that you need to know about this. As with a JV, each independent owner, each tenant can own the same or a different amount of the property. If there's 3 people, you can each own 33.333%, or maybe one of you owns 50%, the other 2 own 25%. It can be however it works out to be. And that's going to be based on the amount of money that you're investing. So going back to that $1 million deal again, and you have to put $200,000 down. If you have $200,000, let's say you have 3 investors. You're investing a total of $200,000 into this deal, 20% down on the $1 million, and you have one that's going to put in $100,000, and the other 2 are going to put in an equal amount. They're each going to put in $50,000. So that's actually going to correlate directly to their percentages in it. So they're going to own 50,000 or 50%, 25%, and 25% of the deal. So that's how that works, and that also correlates to their voting percentages in the property itself. So if the 3 of you cannot agree on something, and you have to actually go to do a vote, that's kind of how it would go. That basically sums this up. Each of these 3 things is a way for a person that wouldn't normally be able to invest in a larger asset to invest. They're pooling money together with a group of like-minded individuals, and they're making a project happen. They're purchasing a project that they wouldn't normally be able to. And again, that could be because a lack of money, or maybe a lack of knowledge, or maybe both. If you're lacking knowledge, then the LP side of things would be your best option in a syndication. If you're just lacking money to close on a deal by yourself, then any of these 3 could be a potential option depending on the size of the property and the other particulars that you're looking at. As mentioned, there's a lot of moving parts with each of these items, and I did not get into any of them. We only touched the surface. So let me know if you have any questions. Love to answer them. If I can't answer them directly, I will reach out to my network and get the answer for you. Thanks for watching. This is Ryan.